morning and welcome to Charting the Markets on Monday, the 29th of January 2024. Asian markets did really well overnight, earlier this morning, after a strong session last week in the US and in European equity markets. Chinese markets also started off the day on a strong footing, but then basically sold off. So at the beginning of the day, we had the Chinese regulator saying that it would suspend the lending of restricted shares. But we also then heard that the troubled property developer Evergrande has been ordered to liquidate, and that led to Chinese stocks selling off once more. Now, with regards to the European session early this morning, we started off on a relatively mixed footing, and we are quite trading in a quite environment with relatively little volatility. And this is to do with the fact that we have got a lot of macro data out this week. We've got the Fed and also the Bank of England monetary decisions. And then on Friday, we've also got the US non-farm payrolls to look forward to. But in the meantime, we've got the remaining 5 of the Magnificent 7 tech stocks in the US reporting on their own earnings, and this should give us some further impetus either to the upside or to the downside. But what is pretty likely is that we will see a spike in volatility at some stage during the week, and that's why later on today, with regards to the trade of the week, we will probably buy volatility and buy the VIX index. But more about that later. Let's start off with the FTSE 100, and you can see here that last week, after a gradual week of advance, we had a very strong acceleration to the upside with the FTSE 100 rising by about 1.4% on the back of LVMH, the French luxury goods maker, basically its stocks rallying by close to 13% and leading to other UK luxury goods stocks such as Burberry, for example, also rallying and pushing the FTSE 100 to a one-week high. And you can see here today little volatility happening here as the economic calendar is pretty empty, and as we're looking forward to these earnings out of the US in the course of this week. Now, if we were to take out today's intraday high at 7,665, the next possible upside target is this minor high here on the daily candlestick chart, this reactive high here at 7,694, together with the high seen back in October at 7,702. And then above there, we've got the high going back to September of last year, 7,747, as another potential upside target, together with the 7,769 December high. So not much expected with regards to upside pressure to be seen later on today. Support, there really isn't much support unless we get down to the 12th of December high at 7,609. And then below that, we've got some pretty good and important support between the orange line here, the 55-day simple moving average, and the red line, the 200-day simple moving average, and also the high seen back in mid-November and at the beginning of December. And these come in between 7,576 and 7,535. So that's a really, really strong support area. But as long as it holds, the trend's your friend, and that is pointing up for the time being. When looking at the European markets, we can see that the DAX 40 contract is also struggling ever so slightly here. The German stock index having nearly risen back to its December all-time record high last week. And that was on the back of SAP, the only European tech stock as such, with ASML, both of these basically leading to European stock markets rallying quite significantly, and Euro Stoxx 50 incidentally rising to the highest level seen since 2001. And that took us on this daily financial bed on Friday to 16,969 on the DAX 40 contract, but not quite to the psychological 17,000 mark, which still remains in play. Now, today we are seeing minor profit taking here. Not much volatility, though, and basically we are also awaiting the results of the likes of Alphabet, Amazon, Apple, Meta, and Microsoft over the course of the next few days. Now, from a technical perspective, we have support coming in on the 11th of January at 16,841. That's a possible support area. And then we've also got support going down to the 15th of January high at 16,792. And basically, if we were to take out the highs seen on Friday at 16,969, I wouldn't be surprised if we were to retest the December high at 17,003 and probably also make a new all-time record high. Now, in the US, we've seen the S&P 500 last week continue its ascent to a new all-time record high on this daily financial bet at 4,907. And don't forget, the S&P 500 has risen for 12 weeks out of the last 13 weeks. So we're seeing a really a strong US market here trading to the upside. But don't forget that the fact that this week's 5 out of the remaining magnificent 7 stocks in the US report their earnings, they make up about 30% of the S&P 500. So we could see some volatility creeping into this index over the next few days. As you can see, volatility was on the vein of the last few days, with smaller candles here being seen after the strong advances, the long candles we saw the week before. So if we were to rise above 4,907, honestly, the only really targets we have to look up for are perhaps the 4,950 area and the psychological 5,000 mark. And support, however, comes in at last Tuesday's high at 4,877. Between that and also Thursday's low at 4,868, that's a pretty good support area short term. And in longer term, we have really good support coming in between here, the 11th of January high at 4,803 and the December high at 4,795. But right now, we'll have to see whether we will see a spike in volatility with regards to the earnings that we expected to see over the next few days in the US, and also with regards to European stocks. The US dollar has been less interesting than other markets, such as stock markets, over the last week or so. But you can look at euro dollar and see that overall, the greenback is still appreciating. And as you can see here, we've now, after a sideways trading range of about 8 to 9 trading days, we've now slid through the red line here, the 200-day simply moving average at 108.44. Did so 3 times last week, but every time managed to just about close on a weekly chart closing basis, a daily chart closing basis, a New York closing basis, above the 200-day simply moving average. But today, are once again falling through it. And it looks to me as if we could fall through Friday's low at 108.13, in which case we could not only slide towards 108, but probably also towards the 107.56 early November high and the 107.24 December low. So that's the next downside target area for me from a technical perspective. And this should remain in play as long as we stay below the last reaction high. That's to say last week's high, which was made at 109.32, because we have a series of lower highs and lower lows. It is likely that further weakness will take the euro against the US dollar to lower levels still. Now, the picture is slightly more positive with regards to the British pound against the US dollar, because you can see here that since the end of November, we've been trading in a sideways trading range. And if I zoom into that trading range, we can see that basically we are just continuing to sideways range trade here. And you can see that last Friday we rose to 127.58, but then came down again. The Friday's low was made at 126.76. And today we're just trading a low volatility sideways trading range between these extremes. Now, if we were to fall through Friday's low at 126.76, we would have the orange line here, the 55-day simple moving average, and also the low from last Tuesday in our sights. And these come in between 126.53 and also 126.50. So that is a possible downside target area. But unless that gets taken out, we remain in this sideways trading range. If that were to happen, though, if we were to fall through 126.50, we could reintegrate this previous key support area going back to the end of December between 126.12 and 125.97, the recent lows we've seen. And on the flip side, we would have to take out Friday's high at 127.58 for us to retest this 127.75 to 94 area made up of the mid-December, mid-January, and highs also from last week. Another currency pair which looks quite interesting is the US dollar against Japanese yen, as the Bank of Japan retains its dovish stance. The currency pair continued to advance. It hit a 6-week high at 148 yen and 80 sen on the 19th of January, but since then on this daily financial bed retraced lower last week to Wednesday's low at 146.65, but has since then continued to trade in a low volatility sideways trading range. And as we can see here, we're being held up by this lower uptrend channel support line, which today came in at 147.72. This so far holds. If it were to be fallen through, and if we were to fall through also Friday's low, 147.43, we could then slip back again towards this 146.65 low. And only a fall through that, as this is the last reaction low, a low on the daily candlestick chart, which is lower than the one to its left and to its right, would we then have further downside in store, probably take us towards the orange line here, the 55-day simple moving average at 145.86, and perhaps even the 200-day simple moving average here in red at 144.35. But as long as we stay above 146.65, which actually looks more likely since we have a series of higher highs and higher lows and we are trading in an uptrend since the beginning of the year, we could actually retest the 148.80 high from last week or the week before, and a rise above there would re-engage the psychological 150 mark. The oil price continued to advance, and this morning spiked higher, as we can see here on the front month's Brent crude oil futures chart. And what we can see here is that we rallied all the way up to 83.93, a level last traded in at the end of November of last year. And this happened as oil has seen the best week with regards to gains since September of last year, on the back of heightened tensions in the Middle East. I mean, we had this deadly drone attack by Iran-backed militia on a US Army base in Jordan over the weekend. We had also attacks over the weekend on a British tanker, the MV Merlin Luanda, which incidentally was actually carrying oil from Russia. And we don't know the Houthis were actually aware of that or not. But the crisis seems to be spreading basically from container ships, which de facto are not going through the Suez Canal anymore, except for container ships which are sailing under a Russian flag. And we're going from container ships, we went to dry bulk, and now we seem to be going to energy with also oil tankers being attacked. And we're getting ever closer to a 1970s style of de facto a shipping blockade, which could lead to future inflation. And on these worries, you also saw the oil price spike higher as the worry about future supply being perhaps curtailed because of this has led to a rise in the oil price. So short term, we're coming back down again. We closed the gap with Friday's high. And basically, as long as we stay above the high seen back here on the front month futures contract at the end of December at 81.44, further upside is likely to take us to above the late November high at 84.58. And if that were to happen, we could then rise all the way back up again towards the psychological 90 mark, and that is a distinct possibility as we're forming this bottoming formation on the daily chart, as you can clearly see here. But for this to be confirmed, we need to take out the last reaction high here at 84.58. There is already a pretty high probability that we have bottomed by rising above the late December high at 81.44, but that would rise above 84.58 would even confirm this reversal, the bullish reversal, even more. Now let's also have a look at the gold price, which actually has been less interesting than other commodities of the past week. As you can see here, we've been trading in a sideways trading range around this orange line, the 55-day simply moving average at $2,027 per troy ounce. And we basically remain so far above our support line going back to October of last year, as you can see here, and that has held the gold price last Thursday at $2,010, and basically below that we've also got good support going back to the late October high and late November highs between $2,009 and $2,007, and the current January low at $2002. So we've got this really, really good support area between 2010 and $2002 per troy ounce. And as long as we stay above there, further sideways trading is likely to be seen. But we would have to take out the 19th of January high, $2,039 per troy ounce, for us to be heading back up again towards the 12th of January high, $2,062. But until that happens, or unless that happens, further sideways trading is likely to be seen. Another precious metal I'd like to look at is the price of silver, which has also bounced back from its low seen last week at $21.93 per troy ounce, but which is losing upside momentum as it is hitting this December to January downtrend line. And as you can see here, we are just trading sideways now and trading water. And basically, we would have to rise above today's intraday high, $23.04, for us to perhaps try to reach the red and orange lines here, as well as the 12th of January high, which come in between $23.53 and $23.61. These two lines being the 200 and also the 55 days. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is @AxelR_IG.